Happy Thursday out there, Team 42. It's your skipper here, Darius Dale, to present our macro minute for Thursday, November 30th, 2023. We'll start with our executive summary from today's leadoff morning note. If you'd like the analysis supporting these conclusions and or what to actually do about them in your portfolio, obviously need to be a client of 42 Macro. So we'll start with number one. Today's October PCE report confirmed our view that the resiliency of the U.S. economy would begin dissipating in Q4, thanks in part due to reduced fiscal support of the household sector. Number two, the October PCE report disconfirmed our developing sticky inflation theme and suggests asset markets may have to wait a few quarters before investor consensus is forced to comprehend the difficulty of traversing the last mile of disinflation required for the Fed to achieve its 2% price stability mandate in the absence of a recession. All bets are off if a recession does develop in the interim, however, as that outcome is highly likely to produce the Fed and White House's desired inflation outcomes. And number three, regarding recession, this morning's initial and continuing jobless claims data did increase the probability of a near-term recession in the U.S. economy, albeit marginally and only to a middling level. Specifically, the 3-month annualized rate of change of continuing claims accelerated to plus 24% and has remained above its recession signaling threshold since late October. The acceleration did cause one of our 42 macro Fab 5 recession signaling indicators to breach its recession signaling threshold, specifically the 3-month annualized rate of change of the continuing claims total labor force ratio. And then this morning we have a special fourth bullet here. Didn't want to jam it all into 3 bullets. I wanted to definitely make sure those were unique. These are all unique observations and quite an important one here. Number 4, discretionary investor positioning is likely extremely overweight equities per the AAII survey, indicating elevated risk of a near-term correction. Moreover, our global macro risk matrix indicates the current Goldilocks top-down market regime is approaching a strength of signal level that has historically signaled a reversal into risk-off market conditions, if only temporarily. Transitioning to my 42 macro dashboard here, we'll start with our daily rundown of our signals from our friends over at Longbow. We have a near oversold signal in the NASDAQ, but very narrow range. Obviously, the market's been kind of trading sideways for a couple of weeks now, so ranges have narrowed pretty substantially in recent weeks. We got a overbought signal here in crude oil. This is Brent crude oil here. Also be aware of that if you played the bounce heading into the OPEC. And then lastly, that overbought signal in crude oil is extending itself to DBC, which is the broad commodity basket there. In terms of a question, we'll end with a question from our 42 macro aware community of thoughtful investors all across the world and across the entire investment spectrum. You got obviously sophisticated professional investors as well, and asset managers, as well as sort of less sophisticated retail investors who may be a little bit earlier in their learning journey. Is a great safe environment for folks to come and learn, not just from me but also from each other. And so I'm very proud of what we built here. So we got a question here. It says, what will be the new generational wealth builder for the everyday family? I'll paraphrase. It's obviously a long question here, but generally the question effectively asks, hey, with real estate and rental property specifically being one of the key ways a lot of families have generated generational wealth here in America, obviously with the regime change that we've seen in interest rates, what will be the new generational wealth builder? And the first thing I'll answer to that question is determining what's going to be a generational wealth builder. Talking about how an asset class is going to perform on a relative and absolute basis 10, 20, 30, 40 years from now. In my opinion, that's a fool's errand. I mean, no one has a crystal ball that can see into the future with any accuracy on those time horizons. That said, we've done a tremendous amount of empirical work with respect to the current fourth turning regime we're in as relates to what investors should specifically expect from the economy, what they should specifically expect from policy, and what they should specifically expect from asset markets throughout the duration of this fourth turning, which my former colleague Neil Howe and certainly one of my mentors would suggest that is likely to persist throughout the next 10 years plus. So in that context, if we're going to receive, things like significant budget or experience significant budget deficit expansion, currency debasement, financial repression, all those things are supportive of assets that have some perceived scarcity. So things like Bitcoin, private debt, and even pockets of real estate, particularly in the right regions, are all kind of fit that mold in terms of building generational wealth. So I don't think you have to make this this question particularly complicated. Obviously, we've built our KISS portfolio construction process uncomplicates the whole act of investing for the retail and RA investor community. So we're very proud of that. So I don't think you need to be answering these very difficult to answer questions as it relates to what to do with your portfolio, because we're going to be there the entire time helping you navigate the changing macro landscape. So we'll wrap it up there. Darius Dale presenting our macro minute for Thursday, November 30th, 2023. Best of luck out there today. We'll catch you back here, or actually, no, we won't catch you back here tomorrow. I will be offline tomorrow prepping for our macro class. So we will catch you back here on Monday. So everyone have a wonderful day. Cheers.